Hi everyone, in this video I'm going to answer which dividend stock is the best one to buy for passive income investors. I'm going to do three stocks: McDonald's, Ford, and Mastercard, and I'm going to answer which one of those three dividend stocks is the best one to buy for passive income investors. I'm going to look at 4 or 5 different metrics, starting with the dividend yield. So let's get right into it. McDonald's offering investors a 1.59% dividend yield. Ford offering investors a 4.27% dividend yield, and Mastercard offering the lowest dividend yield at 0.56%. Now, dividend yield is not the most important metric to look at if you're a passive income investor, because if you're investing in these dividend stocks, you're probably looking at holding these stocks for several years. So while the dividend yield is what you would get right now, you also want to look at what are the chances of these companies increasing the dividend payment over time. So to answer that, I look at the normalized earnings per share over the trailing 12 months, and I also look at the dividend per share over the trailing 12 months, and I look at how much a company's paying in dividends compared to its earnings per share. And if that gap is wide, that means there's room for the company to increase its dividend. So starting with McDonald's paying dividends of $5.66 over the trailing 12 months compared to its earnings per share of $9.42, it's paying more than 50% of its dividends, of its earnings in dividends. Meanwhile, Ford paid a dividend of 50 cents in the trailing 12 months and earned an earnings per share of $1.02. So also roughly 50% of its earnings paid out in dividends. But look at Mastercard here. In the trailing 12 months, it earned $10.69 in earnings per share and paid only $1.96 in dividends per share. Less than 20% of its earnings were paid in dividends. That means it has significant room to grow its dividends sustainably because its earnings power is high and it's growing. The next thing I wanted to look at is revenue growth, because revenue growth is what fuels earnings growth if the company's on a sustainable, profitable footing, which all three of these companies are on. McDonald's revenue growth was negative 1.37% in its most recent quarter, and its overall revenue growth is roughly flat. You can expect over the longer term low to mid single digit growth rates from McDonald's over time. It has signaled that it's going to accelerate its store opening, so that's going to give it a bit of a juiced up revenue in the near term, and it's also increasing its comparable store sales because of its prudent investments in its digital channels. That's really helping fuel new customer growth and increased ordering from each customer now that you can order for delivery and order on the app for pickup. Ford, meanwhile, is experiencing boom times in the near term as manufacturing of cars has been constrained because of supply chain shortages. Ford's been able to shift its production to its higher priced, higher profit models, selling them without incentives, without discounts, without promotions. That's really been a boom to Ford. However, you can't expect that to last longer term, maybe for another 4 to 6 quarters before the industry normalizes. And again, Ford, you can expect low to mid single digit growth from Ford. Mastercard, meanwhile, grew revenue at 11.52% in its most recent quarter. Mastercard takes a percentage of all transactions that happened using a Mastercard card. So as consumer spending increases, Mastercard's revenue increases. And the good thing about Mastercard is that inflation is a positive for Mastercard, right? Because if you're spending more for the same amount of goods, that means the total purchase amount is increasing. That means the percentage of those totals are increasing. And so Mastercard will catch a tailwind from this higher level of inflation. And also Mastercard gets a tailwind from international travel, which is expanding now that economies are reopening and travel restrictions are easing. Finally, I wanted to look at valuation using the forward price to earnings ratio, and Ford is the cheapest out of the three, trading at a forward PE of just 8. Mastercard is the most expensive at a forward PE of 29.63. McDonald's is in the middle with a forward PE of 25.48. However, if I'm a long-term passive income dividend stock investor and I had to pick just one of these dividend stocks to buy, I would say Mastercard is the best one to buy here because of the potential for continued growth in the dividend per share. It can continue expanding it because it's paying such a small percentage of its earnings out in dividends right now. It can increase its dividend per share. Even if earnings per share stay relatively flat, there's room for it to expand its dividend. All right. That's all I've got for this video. As always, I really appreciate your viewership. Thank you for tuning in, and I really hope I can see you again next time for another one of my videos. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.